Before we start the program, I would request everyone to kindly take their respective seats and please put your cell phone on silent mode. Thank you for your cooperation. ICC is organizing this program in association with Ashok Maheshwari and Associates, Elliott Davis, and Majmudar and Partners. I would briefly introduce all the organizations. Established in the year 1981, Ashok Maheshwari and Associates is a firm of offices situated in Gurgaon, Mumbai, and Kalkaji in New Delhi. They are a chartered accountants firm. The firm is a full-service firm, and Amit specializes in international tax and foreign exchange regulations. The partners provide their views to all leading media publications in India. I would like to briefly introduce Elliott Davis. Founded in 1925, Elliott Davis is one of the largest accounting, tax, and consultancy services firms in the Southeast and ranks among the top 50 CPA firms in the United States, with a concentration on core industries as well as niche areas and emerging business sectors. Elliott Davis offers comprehensive solutions to diverse businesses, organizations, and individuals. By delivering fully engaged quality service, they ensure their clients are highly confident and well equipped to make key financial decisions. I would like to give you a brief on Majmudar and Partners, formerly Majmudar and Company, established in 1943, has evolved into one of India's premier law firms, representing the who's who of banks, companies, and financial institutions. Banking and finance, corporate M&A, infrastructure, tax, restructuring and insolvency, technology, IP, employment, and real property law are the main practice areas of the firm. It has an active litigation and arbitration practice that cuts across all the firm's practice areas. Majmudar and Partners has offices in Mumbai and Bangalore and integrated network offices in New Delhi, Hyderabad, and Chennai. It services clients nationally and internationally. So before we begin the proceedings, I would like to state that we have very renowned speakers from eminent firms today, each of whom is an immensely prominent personality in his respective field. We will not be doing justice by introducing all our speakers and firm in just 2-3 minutes. So in order to save time, we have distributed profile of all speakers and firms for your reference. We will therefore make brief introductions. May I now request Ms. Rakhi Panda, Regional Director of Indo-American Chamber of Commerce, West India Council, to kindly deliver the opening remarks. Rakhi.
Thank you, Trishna. Mr. Nishit Desai, Founder and Managing Partner, Nishit Desai Associates, and our session chairman today. Mr. Amit Maheshwari, Managing Partner, Ashok Maheshwari and Associates. Mr. Thiru Govinder, Shareholder in International Practice, Elliott Davis, USA. Mr. Ruksha Davar, Partner, Majmudar and Partners. Ladies and gentlemen, a very good morning to all of you. On behalf of the Indo-American Chamber of Commerce West India Council, I extend a hearty welcome to all of you today for this morning's important program on investing in the United States. I particularly welcome Mr. Desai, Mr. Maheshwari, Mr. Davar, Mr. Govinder, whom we are privileged to have with us today to address the gathering. Unfortunately, our regional president and both our vice presidents are traveling abroad, because of which they are unable to attend the program today. But they have directed me to convey their hearty welcome to all of you present here. Well, the growing trade relation between India and US are driving greater opportunities for Indian companies to invest and expand their business in the US. However, starting a business, no matter whichever country you do that, it involves a great amount of risk, for which one should analyze the market while creating a subsidiary and take broad views of factors like, pitfalls of acquisitions and so on. In the present economic scenario of US, new trends in lifestyle, business, health, and other aspects of life are opening doors to new business opportunities. So today is a unique opportunity for all the Indian company representatives present here to understand the factors while doing direct or indirect investments in US. The Indo-American Chamber of Commerce, established in 1968, is the only bilateral chamber in India promoting trade and commerce and business between India and US. Today's program is an extremely important adjunct to ICC's efforts to address topics of concern related to India and US. I'm indeed thankful to Ashok Maheshwari and Associates, Elliott Davis, and Majmudar and Partners for providing us with this opportunity to organize this program. Before I conclude, I would also like to mention that Indo-American Chamber of Commerce is organizing the 10th Indo-American Trade Excellence Awards, which is co-hosted by US Consulate General, Mumbai, on the 2nd of July at Trident, Mumbai. Through these awards, the Chamber will celebrate trade excellence and recognize the best Indian companies in the US and best US companies in India in various categories. A handout with the brief about the awards program is distributed for your reference and use. Thank you. May I now request Mr. Nishit Desai, founder and managing partner of Nishit Desai Associates, our session chairman today, to kindly take over from here. Thank you, sir.
Krishna. Thank you, Raki. I'm actually brought by the presence of Ami and Thiru, Rukshad, a brilliant panel here, and of course, even the audience is looking even more brighter and smarter and excellent. I think it's really am I audible? What's happening? Okay, this was contrary. I think when light came off, it means mic went off. And when lights went off, mic seems to be coming up. So anyway, what I was trying to tell you, I think we have a brilliant audience here and brilliant speakers here. I'm really privileged to be talking and chairing this session this morning. Coming to investing in the United States, what has happened lately? Why is sudden interest in the US? And most of you may be aware that US is going to be self-sufficient on gas and oil requirement by 2017. They really don't need to import oil and gas. And, but at the same time, they will continue for political and other reasons. They do not want environment and other things to be spoiled, and therefore they may not do what their potential is. But effectively, their reliance on the overseas markets is reduced, and it's creating its own opportunities. I believe the growth rate has gone almost to 3%. Now I'm told it could be as high as 3.5, unlike Europe, which is still sagging. Number three, particular development in Crimea and the Ukraine, I think the investment that was already going there is little surplus that would have to find its way. I was always of the view that India could have potentially tap this particular opportunity, and hopefully the new government coming in will see a lot more changes and hopefully a lot more hopes. But a lot more allocations have already happened as far as funds are concerned in the last quarter of last year and particularly first quarter of this year. So, you know, we might have missed a boat to some extent, but hopefully things would come. There is going to be some kind of a spillage because of this situation, because where else people would invest. And that's one of the other things. If you look at the market currently in the US, California is bustling with activities, you know. Property prices have almost doubled in last 2 years or 3 years. New York similarly has again been, you know, been very, very active, and some of you might be aware that on the Park Avenue, 57th Park, has become billionaires row now, you know. So, you know, I think whole US is showing up some signs of resurgence. Of course, where it will lead to, we do not know. But technology companies and other biotech and other ones are again coming into the main stage, you know. So I think we are seeing a lot more opportunity. On the other hand, even Indians are aspiring to invest abroad. Good opportunities exist in the Midwest and perhaps even Southwest as well, because there are many family-owned companies in the Midwest which are looking either for generational investment in India, because they are family-owned companies. They don't invest like private equity or VC for 5-7 years or so. Usually their call is 10, 12, 15 years because they want to move on. So they are looking at investing in India. But as far as Indian companies are concerned, they would also have opportunities to acquire small brands and companies in the US, just like they have done in the Europe. So I think these are some of the opportunities coming up. I do not want to take too much of time. It's very important to understand that federalism is very strong in the United States. So you get federal laws, but you get stronger even state level laws, which you really need to be, that's why, the importance of Elliot and Amit and Rukshad and this comes up, because these opportunities are very regional as well. And you need to understand regional issues. In India, we are highly centralized kind of, we have a highly centralized planning, and therefore a lot of focus goes on the central government. Yes, there it is, but I think at the state level also you need to understand the laws are so different. And I, in lighter vein, always say United States of America is never United States, it's always un-United States of America, because, a lawyer in New York, if he has to practice in California, for example, he has to again go through the bar, again go through everything. He cannot practice. So a number of senior lawyers go as junior lawyers when they have to practice in California. So there are many examples I have seen with gray hair included. They go and work like interns, and that's the side. Unlike India, we have anywhere you can go and do anything what you want, So there are a number of laws that are so state specific. You got to be very careful about that, and you can't afford to trip. And with these words, I would, would like to conclude my inaugural talk and leave it to now, Amit. You already been introduced, so I'm very happy that you got a brilliant speaker here once again. And may I request Amit to take the.
Good morning.
Yeah.
Good morning, everyone. I would like to thank IACC for hosting us today. Last year, our firm Ashok Maheshwari Associates set up an India-US corridor to develop, support, and facilitate US-India bilateral business opportunities with Elliot Davis. The corridor is set up with an aim to provide a platform for domestic entrepreneurs in US and India to invest into these countries. We did a similar seminar in US in March, wherein we covered investing in India, and that was hosted by Elliot Davis. Me and Rukshad spoke there, and we saw a lot of interest there as well. So with this, I would like to now hand over to Thiru to take forward the presentation. And like Mr. Desai said, there are a lot of state-specific incentives also which are given by various governments. So he will also touch upon what kind of incentives he will get in Carolinas. So over to Thiru for the presentation.
Very good morning, everyone. Firstly, I'd like to thank IACC, Ashok Maheshwari and Associates, Majmudar, and Mr. Desai, for hosting me here today. We've had a very successful week with these seminars in other cities, and I am greatly thrilled to see the turnout here this morning. Thank you very much for coming. I am humbled, actually, by the great panelists that we have here today. So I'm really thrilled to be a part of this presentation. There's a few things I'd like to say before I start. This presentation is extremely high level. The goal is to give you an idea of what you should consider doing business with the US and doing business in the US. So it highlights some general information. It highlights income tax structures and considerations, some legal considerations, as well as how to get to the US, and very high level exit strategies. So before I get started, just a little bit about Elliot Davis. We were founded in 1925. We're probably one of the only CPA firms in the US that hasn't changed its name from day one. So that gives us a lot of pride. We're over 500 people at this point. We have 8 offices in 4 states: North Carolina, South Carolina, Georgia, and Virginia. We're a member of the leading edge Alliance, which is the second largest association of accounting firms, and that gives us a global reach so we could better serve our clients internationally. We rank among the top firms in the US serving listed companies, and as you may know, not any accounting firm can serve listed companies. You got to go through stringent criteria. Okay. Just to give you a geographic a visual, these are the states that we're in. So primarily in the southeast. So even though we're based in the southeast, we service clients all over the country and all over the world. You may notice the cities in the states that we're in. We are present in all the capitals of those states, which enhances our relationships with the government and local cities and states, so that we could be more influential and provide more value to clients or companies coming to those areas. And as Mr. Desai mentioned, it's so regional that each city and state is different. They provide different incentives to come in. So that gives us a slight advantage. Okay, very high level, this is the industries we focus in. We believe in industry specializations, so we can have experts dealing with your specific issues and not generalist. Okay. Just a quick profile of our background. As you know, audit and tax compliance, consulting. We're in the top 50 firms in the US as of 2012. Just to give a little appreciation for that number, there are over 14,000 CPA firms in the country. We spoke about SEC registrants, and a stat that we're very proud of is in the state of South Carolina, we are the largest firm, and that takes into account all Big Four. Okay, as Mr. Amit mentioned, we formed the India-US corridor that we're calling the Gateway to India. We hosted Mr. Amit and Mr. Rukshad this past March in the US, and we had a successful roadshow as well. And this is the reciprocation of that, and that's what brings me here today. So the rationale and the reason for that was to provide a platform for you and for the US companies coming to India and for you going to the US to handhold you and make sure that process is efficient and non-burdensome, because there are a lot of perception issues that we try to mediate. So this platform that we have, we'll have a set of experts for you. Of course, the audit and tax advisors will have a referral for you for legal. We have bankers, and of course the city and state officials as well. And this gateway, I think, is going to play an important point going forward. We have two great countries, so vast resources, expertise, but never really exploited those synergies before. And we're hoping on the SME level we can help promote that and help that increase activity on both sides of the border. Okay, investing in the US. So before we go to investing in the US, working with the US. If you're not in the US now, you may be doing business with the US, and you may know that there is some level of impatience, especially when you're dealing with your customers in the US. They like very fast turnaround. They like things done yesterday and not tomorrow, especially if you see how things work in New York City and how hectic things are. That drives it, actually. Everyone's focused on productivity. Everyone's focused on driving the bottom line at all levels. So that helps that mentality of promoting business and creating jobs as well. So quite a few things to consider, doing business with the U.S. Cultural as well. That's a very important part of things, and I think the U.S. fits in very nicely because it's not unfamiliar to the Indian community. You name the state, you throw a dot on the 50 states, and I can guarantee you there's a large Indian population there. So you're not going to you are going to a foreign country, but you're not going to a foreign culture as such. Okay, so that also helps coming to the U.S. Working with the U.S., U.S. companies, I mentioned a lot of proactiveness. These days with technology, we get carried away with email, we get carried away with texting and WhatsApping, and we forget about the face-to-face communication. And in the US, that's still very important. We see other foreign firms, other cultures still embracing that very strongly. And that's very important. You cannot get things done over the phone as fast and efficiently as in person. Okay. There's also various legal considerations working with the U.S. Contract formations, contract terms, and we'll go through that shortly. Okay, so working with the U.S. fits into doing business in the U.S. So to have a successful business overseas, one of our surveys that we've done with our foreign clients was, what was the driving force? Why did you come to the U.S.? And that fitted right into what I just mentioned was they want to be closer to their customers. Okay, customer relations is so important. Customers want short lead times. As you may know, manufacturing is starting to move out of China again. The U.S. is trying to bring that back to the U.S. Or closer to them, and that's one of the reasons, shorter lead times. So it's the same concept. If you have customers there, they don't want a 5 or 6 week shipping process. They want it in 2 or 3 days. So being in the U.S., you'll also lower your shipping cost, of course. You'll avoid supply chain issues, and the best of all is the frequent visits to your key customers or to all your customers. And they also find various opportunities at these customers if they're face-to-face for adding value and also increasing businesses. I mentioned legal consideration, there's compliance issues. As you know, the legal environment is extremely litigious. Contract terms and conditions are very important to pay attention to. And of course, you've got to do your due diligence. So additional reasons, FDI. I'll be remiss to say, if I don't say that the FDI has been one of the primary drivers of the U.S. recovery at this point. Even to the downturn, FDI was still flowing in. And these stats are from 2002. You can see 2012. Sorry, 166 billion flowed into the U.S. India is one of the fastest growing FDIs. It did decrease a few years ago, but it's on the increase at the moment. A few examples of Indian companies contributing to the FDI in the US. Essa Group invested 1.6 billion. Tata Group, 3 billion. Jubilant Organisys, 246 million. And you can see the sizes vary. Okay, these numbers are large. Even 20 million is a nice size, but there's also the 3, 4, 5, $10 million transactions that's occurring. And all this contributes to the recovery of the US. FDI is not concentrated. By that I mean it's spread across the US. There is no particular area or part of the country where you can say there's even 30% of the FDI. And another reason is access to capital, access to low-cost capital. Of course, the qualified workforce, competitive free market is a big plus in the U.S. Wide range of industries. We're not industry agnostic. We're, we cater to everyone. Regulated markets. This is a very important point, especially for investing. If you're investing in the U.S., we do have regulation, of course, but a lot of the regulation is to protect investors. Intellectual property. As you know, some countries don't respect intellectual property. I see some smiles, that's right. But the US, you know, it's extremely respected and protected. And, you know, all the attorneys, I mean, they love it. So you're protected from that standpoint. I mentioned government regulation, and that ties into intellectual property rights as well. As you know, the US is vast. I mean, there's 50 states. And as Mr. Desai mentioned, there's the federal government, and each state has their own government. The tax laws vary by state. Incentives vary by state. Infrastructure varies. And most times it's influenced by the industries in that state. Human resources, depending on industries, depending on expertise. And of course, industries. You know, just for an example, Ohio is very famous for the automotive industry. You know, Michigan, again, automotive industries. So they all fall in. So that's where you would see a big concentration of auto. So this presentation today, you know, I'm going to focus on North Carolina and South Carolina, just because there's just, to focus on all 50, we'll be here for a few weeks. So if there is, though, particular interest in other states, you know, we can talk afterwards, and I can get back to you with information. So for now, we'll focus on North Carolina and South Carolina. Okay, just to give you a graphic visual again, you'll see North Carolina. Let's see if this is a pointer. Okay, that's all North Carolina and South Carolina. Okay, and Charlotte is right in the center, so that gives you the best of both worlds. Okay, so North Carolina is the 6th most visited state in the U.S. Charlotte is the 7th fastest growing city. Oh, by the way, has anybody heard of Charlotte? That's great. So on this slide, just to focus on two very important points. It's the 2nd largest financial center in the US after New York. And the reason being is that it's the headquarters for Bank of America, who employs 15,000 plus. Also, prior to the Wells Fargo-Wachovia merger, it was the headquarters for Wachovia. So, and we also have the 3rd and 4th largest banks in the surrounding area. So that's what makes Charlotte the largest financial center outside of New York City. A very impressive statistic. Charlotte is the home, or the Charlotte area is the home to over 950 foreign companies, representing 47 countries and counting. Every other week, there's a company coming to the area, which shows both the states and the city, they're doing something right to attract these companies. And we'll get to the incentives shortly. Okay, 1 of every 4 residents holds a bachelor's degree, and the median age is just over 36. The labor force is 1.4 million. I believe the total population of the Charlotte area alone is just over 2.3 million. 60% of the employment is white collar, you know, driven by, again, the finance field, insurance field, and real estate. Now, I will come to manufacturing shortly, but outside the financial services sector, manufacturing is really growing. It's growing fast. And in fact, outside of financial services, I would say manufacturing is the next biggest industry. And you know, being the 2nd largest financial center, it overshadows manufacturing. But manufacturing is a very big play in the market. Unions. North Carolina and South Carolina is the lowest unionized states in the country, and those are the percentages, 2.9 and 3.4%. So based on, so that means that they are both right-to-work states, so you're not obligated to join a union. And we all know the pros and cons for those. We spoke about the industries. Another big industry in the Charlotte area is IT, and that's of course a very broad category. It could be software development, outsourcing, a whole slew of businesses. Okay, manufacturing. The highest density of manufacturing in the Carolinas is in the Charlotte area. Okay, and the strengths are in the advanced textiles industries, automotive and truck supplies. And what's driving automotive? Automotive has been driven by BMW, which is about 45 minutes south of Charlotte. So with BMW producing, I believe, the X5 and a few other ranges there, all the suppliers are coming to the area. Plastics, food and beverage, industrial machinery, and building and construction materials. With the vast growth in the area, construction is booming, whether it's residential or commercial. There's a lot of opportunity in those areas. I mentioned the right-to-work state, which is very favorable to businesses. And the next point refers to the education system and the access to talent. And I have a few slides on that coming up. Okay, and there it is. A very large community college system, which is a little different from the university system. Because in the US you have two levels. You have the community college and then you have the universities. So it caters to the entire population. So if you cannot get into the university straight away, you get trained in a community college for whatever technical expertise, and then from there you can go to your degree. So you are not shunned out of an education. So 37 colleges and universities, and these I would say they're very high caliber universities. You have Duke University, you have Chapel Hill, which is a state-run university system. You have Wake Forest. So these are top-notch, highly ranked colleges in the state, in the country. And of course, in the Charlotte area, there's the University of North Carolina, Charlotte, which is over 25,000 students at this point. So the point of this slide is you have access to talent, and you have access to research and development at these institutions, and you have access to academia. Okay. Another reason for the Carolinas or the Charlotte area is logistics. If you're in the manufacturing sector, if you're in service sector, you need to get there. You don't only need to get there, you need to get somewhere from there. And Charlotte has been really booming in this area. Unbeknownst to many, Charlotte is the 7th busiest airport in the world. I mean that's a very impressive stat. U.S. Airways, which recently merged with American Airlines, has a very strong presence there. Moving on to the road system, infrastructure. We have various interstates, various highways that lead you to many of the largest cities on the southeast, whether you're going to New York City, Washington to the north, or south to Atlanta and Florida. Rail. The Carolinas is the home to 2 or 3 very prominent ports. The most common or the most famous is Charleston, which is the state has invested a lot, and there are quite a few Indian companies actually moving into that port and setting up operations there. So 600 plus trains run daily, so you can get your goods wherever you want them. In the Charlotte area, they started a $100 million expansion of the intermodal. So again, that's going to promote business, promote your investments to come to the area. I would say this slide here is one of the primary reasons attracting all those foreign investors, those foreign companies. Not only that, you got easy access to Europe if you have other subsidiaries in Europe, and from there you got easy access to the West Coast as well. Okay, we spoke a little bit about the accessibility. Here's the Charlotte region, North Carolina, South Carolina, and by truck, 1 or 2 days, 3 days, you can go through, the rest of the country. Okay. Businesses relocating, and another significant factor to place your headquarters in the Charlotte area is business cost. That's one of the things you evaluate. You evaluate salaries, you evaluate real estate, you evaluate overhead, including electricity, and by far, Charlotte is below the national average. So starting off with wages. Now, I believe the service and financial services wages is slightly higher than 64,000, but the manufacturing average is 64,000 annually. And yet it's still 5 to 10% below the national average. Electricity is lower. We're the home of Duke Energy, which I'll come to shortly. And the real estate market. Real estate market has been very stable, even through the downturn. Yes, it did fall, but it did not fall significantly. And as of today, it has rebounded very strongly. So with that strong rebound, it's still very affordable compared to the Northeast, compared to the West, compared to California in the West, New York, New Jersey, in the Northeast. I, in fact, relocated from New York to Charlotte, and it was actually an increase in salary by buying a house there. It was so much cheaper than New York City. Construction cost. This is also a factor. If you're building a greenfield or you're building a small manufacturing plant, 10 to 15% below the New York prices. It's actually probably more than the New York prices. The percentage is probably much higher than the 10 or 15%. So Charlotte definitely brings value when it comes to this. Fortune 500 companies. Now, given this is not the audience, we're more on the SME level, but these are the big names that are in the area. And you can see the employment numbers on the right and the revenues in the middle. Okay. This past year, or actually past year and a half, these were the companies that came to the area, and that's been their capital investment. So very significant dollars, ranging from, ranging from, $1 billion. Now, data center, that has been a recent trend, recent uptick in the area. A lot of data centers are moving to Charlotte. And there's one big reason for that, which I'll come to shortly. So again, a wide range of industries. Okay, you got manufacturing, you got energy, Areva, which is a French company. You got a packaging company, you got Facebook. So Facebook has an operation there as well. And you got technology, you got IT, and Infosys has a presence there as well. Okay, so a topic that's dear to everyone's heart is income taxes. We all love to pay them, right? Okay, so the tax authority in the US is the IRS, Internal Revenue Service. I don't have a funny joke on that, but I always say, for them to track down the America's Most Wanted, they shouldn't send the FBI or CIA, they should send the IRS, because they will catch them if they owe taxes. The compliance requirements are quite stringent, but not onerous. Individuals So if you're a US resident or US citizen, no matter where you are in the world, you are required to file a tax return on the individual basis. The individuals are required to file by April 15th. It's a calendar year tax year, so December 31st. And then you have till April 15th to file your returns. Corporations have till March 15th, but they also understand that financials and the books and records take some time to get audited and reviewed, so they do have a 6-month extension period. For individuals, there's a minimum income threshold. So if you're below the income threshold, you don't have to file the tax return. But for corporations, there's none. So if you're incorporated, you have to file a return. Fines and penalties, they do get intense. They do creep up for non-compliance. These are the common types of tax structures available in the US. Many Indian companies, many foreign companies, they enter the US by establishing a limited liability company. And I'll come to the details of that, but it really means limited liability company. So these are the various entities, and I'll touch on a few of them going forward. C corporations. So in general, any of the structures, any of the entities that you would like to incorporate, you have to do it on the state level. Okay, and you document your articles of incorporations with the state. At this point, we would refer you to an attorney to do this. Accountants, CAs in the U.S. or CPAs in the U.S. Don't generally do this for their clients because you need legal advice on this. Depending on your business strategy, your business plan, the number of shareholders, there's many items to consider, and therefore attorneys take this up. And then also while attorneys do it, you could also do it yourself online in the U.S. So that is the cheapest way out, but of course you don't have the expertise and advice behind you. So the highlights of the C corporation: there's no minimum capital contribution, 3 levels of controls that needs to be established, of course at the shareholder, director, and officer level, and you're taxed on all earnings and profits. The advantages and disadvantages. Of course, the shareholders have limited liability, but the board of directors are exempt from personal liability. Unlimited number of shareholders. The disadvantages is double taxation. And what I mean by that is the corporation is taxed on the profits, and then when you are given a distribution on the personal level, you are taxed again. Foreign shareholders are taxed at a flat rate of 30%. Limited liability companies, as I mentioned, this is the most common way that people get into the US and get started. Okay, it's a hybrid of a C corporation and a partnership. Again, you file your articles of incorporation, which is not onerous at all, but legal advisor is highly encouraged. You operate based on your operating agreement that you establish between you and your members, and it's considered a partnership for tax purposes, meaning that it is a flow-through entity. So the company itself or the LLC would not pay taxes. You as the shareholders will include the share of income or loss on your tax return. And that could be advantageous because if you have a loss, it could be offset against your other income. Okay, so some advantages and disadvantages. Limited liability to shareholders and members. So what is meant by that? There's a separation between business assets and personal assets. So a limited liability company, no one can come after your personal assets. Nobody can come after your house, your cars, and your personal bank account. What's at risk is what you have invested in the company. And that's, of course, very desirable. a single level of federal and state taxation, and that's what I meant by being a flow-through entity. You pay tax on your individual level. And that's the advantage of the partnership. Disadvantages, foreign members must pay tax on its income and file a U.S. tax return. So even if you're a resident here in India and you own an LLC in the U.S., you are still required to file a U.S. income tax return. Okay, it does not have a perpetual life like a C corporation. Most states have a limit. Whether it's 30 or 40 years, there is a limit based on the state. And it depends on your articles of incorporation and your operating agreement, which will dictate what happens in the event of liquidation, death of shareholders. At that point, most likely it dissolves. Okay, other entities, partnerships. There's a general partnership, limited partner. Which is basically an association of two or more people. I mean, that's the general definition of a partnership. And all the partners are jointly liable for all debts and obligations. Okay, hybrid entities is taxed as a corporation in one country and a partnership in another country. Depending on the situation, it could be advantageous, depending on the tax system of each respective countries and where you have set up. And that's a very complex tax planning strategy that needs to be discussed up front when you're entering a market. Okay, federal income tax rates. So it's progressive, between 15 and 35%. The U.S. looks at worldwide taxation. It doesn't mean they're going to tax you on your worldwide income. You do get foreign tax credits to offset taxes you paid in other jurisdictions. State and local income tax. So we have a federal tax system and we also have a state tax system. 46 states levy tax on income and others do tax on revenue or taxes on assets. Okay. Nexus. Nexus is a term, if you are already there or looking at doing business in the U.S., it's a terminology sometimes learned too late in the game without prior planning. So if you set up a company in New York and you're selling goods to California, to Charlotte, to Florida, those states want a piece of that. Okay, so they determine, the term is nexus, meaning do you have tax liability in those states? And it's generally determined where you are generating your income. And many times for foreign companies coming in, it's no pun intended, but it's a foreign concept. Nobody thinks about that until at the end, you know, it becomes an issue because they haven't filed those returns. And then each state comes after you and the penalties are high. Okay, so your state tax is based on your federal taxable income with modifications, so there are deductions allowed on the state level as well. There are certain situations where non-US taxpayer has no taxable income for federal purposes, and due to lack of tax treaties, they may not have a state tax base, but that varies from state to state. Revenue tax, I mentioned there's one or two states that do not tax on income, but rather revenue. Other indirect taxes, we don't have VAT, but we have a general sales tax. There's excise tax on certain products, like tobacco and liquor, because they know no matter what they tax it, people are still going to get them. They're still going to pay it. Okay. Foreign investment in real estate. So unlike other countries, you are allowed to purchase real estate in the U.S. You don't have to be a resident in the U.S. You can invest in real estate. You can buy it as a primary residence or for investment. it's taxed in the U.S., so you will, even though you have a property there, you will get taxed on it if it's a rental income. Okay, property tax. This is also a factor for your business. If you own your property, you'll be subject to property tax, which is determined on a city-by-city level, and most times it's based on your fair market value. And in times of rising prices, all the cities like to revalue your property at that point. They don't revalue it when there's a decline, though. But that's always a interesting topic. Payroll taxes, and that's for your employees. This is a business expense similar to property taxes. These are not below the line income tax. These are, I would categorize as general business expenses. Social Security, unemployment tax, your withholding tax, both federal and state level. What this means is that each individual is liable for taxes on the income, and in the U.S., a portion of that tax is withheld with every paycheck, and the company is responsible to remitting that to the government. At the end of the year, when you file your tax return, you compare your tax liability to how much you've paid in, and then you get a refund if you paid in too much or you have to pay in more. So that's an obligation of the company to remit those taxes after they withhold them from you. Unemployment tax, many times companies coming into the U.S. don't know about this. It is a fee paid to the state for the benefit of the employees. So if you terminate an employee, whether it's streamlining, cutting cost, if it's not the fault of the employee can go to the state and say, I was terminated for XYZ reasons, none of them were mine, I would like to put a claim in for unemployment. And that will give them a certain dollar amount for a few weeks, which gives them time to find another job. Okay? And that's determined by company. It's similar to insurance. Each company has a different profile. So you pay based on your profile and your history. Okay? Tax credits, I mentioned earlier, income is, they look at worldwide income, but they do give you credit for taxes paid in other jurisdictions, and that's the formula. Okay, important point at the bottom is there are credits allowed for research and development, and that's taken against your tax liability. The U.S. has various tax treaties. Unfortunately, there is one with India, which reduces some of the burdens, and we'll go through them. And these are the areas, actually. There's a withholding tax when you remit dividends to your parent company. So if you have a company in the U.S. and you want to send money back to the parent company in India, there's a withholding tax on that. Very often, the parent company will fund operations in the U.S. and charge them interest. Okay, well, that interest, there's a withholding tax on that when they remit that money back to India. And then, of course, on royalties and other fees. Okay, so the general rule is 30% on dividends, but with the U.S.-India tax treaty, that rate is reduced to 15% if the Indian parent owns 10% or more. Otherwise, it could be reduced to 25%. If you have a branch in the U.S., you'll still be subject or treated as a subsidiary. I mentioned interest earlier. Again, this is a 30% withholding rate, but with the treaty in place, it could be reduced to 0, but it has to go through a very stringent criteria. But most times it's 10% and 15%. Okay, tax and royalties. This is a tax strategy where you charge your your US company, whether it's management fees or royalties. There's a 30% withholding as well, but this can be reduced, and depending on what the royalties are for, there would be different rates that could be applied. Transfer pricing. This has been, of course, a very hot item in India. We don't have that stringent requirements in the US. It's more of an honor system that you have a transfer pricing policy. However, if you do get audited, the burden of proof is on you. And you've got to show that you have an arm's length transaction. It has been documented contemporaneously with the transaction and not after the fact. And basically this is to prevent shifting of profits to lower tax jurisdictions. So again, here there's no requirement for over 1 rupee, for example. If you're not audited, they wouldn't ask for it. So best practices in the US is to get it done to safeguard yourself, because if they do find that that you were not complying, taxes and penalties could be substantial. Not as substantial as here in India, though, with your recent cases. Thin capitalization. By this we mean parent company funding the U.S. company, and there's more more parent debt, and interest expense is extremely high. That creates an issue, and based on that, your interest deduction is reduced, because as you know, you deduct your interest to come to your net income, your taxable income. So they're saying, well, that could be a shifting of profits issue. So we're going to limit that. If it's paid to a third party, absolutely no problem. But if it's paid to a related party, we got to reduce this. So if your debt to equity ratio exceeds 1.5, then they start reducing how much you can actually deduct. Okay, and most times that amount that is not allowed can be carried forward. Okay, so North Carolina and South Carolina. This is just a high-level comparison of income tax rates, state income tax rates. North Carolina is 5%, South Carolina is 5%. In past years, North Carolina was between 6 and 7%, so they are becoming more and more competitive. And these change based on administration, who is more pro-business. We have a new administration this past year and a half, and that resulted in lowering the tax rates. The various other taxes, I mentioned the sales tax, the personal income tax. So even though you have a federal tax rate for for individuals, you also have a state requirement. I mentioned property tax as a general business expense, workman's compensation. Now that is, I'll just touch on this briefly. So if an employee gets injured at work, and they can prove it was work-related and not a scheme to get some extra money, that's covered by a workers' compensation insurance plan as well. And that's factored in as a business expense. Unemployment insurance, we spoke about that. So this gives you a high-level idea of what the state tax rates are. Now, there are some states that it's zero, but they tax you on assets. So whichever way they slice and dice, they want a piece of your money. Okay, incentives. There's various types of incentives, and it varies by state. There's some non-refundable if there's a contingent aspect to the credits. So it could be refundable, but most times there are non-refundable. Tax abatements, grants. if there's R&D involved, if there's training of employees to give them a skill that they did not have, low interest loans, bond financing. Sometimes the states get involved with that, the cities get involved with that. It'll be on another slide. Depending on your capital investment, they may be able to establish a bond fund. And the last point, research and development support. That's key, especially in the, well, actually manufacturing as well, into your technology, into your machinery, into your processes. Well, processes count as well. And not only, when we think of R&D, we think IT, we think of software development. It also expands to the manufacturing as well. Okay, there's a lot of information on this slide. I'll just highlight a few things, but this is a list of incentives for North Carolina. So employee tax credits could range from $750 to $12,000 an employee. I mentioned earlier a training program. So if you have a really unique manufacturing process or a skill that your employees need and the area just doesn't have it, you're going to need to spend money to get them up to speed, and the state will pitch in and give you $800 to $1,200 per employee, which helps reduces the cost, if not to zero, it reduces quite a bit. Okay, I mentioned data center. Now these are basically hosting facilities on the IT side. That has been a hot oven recently in Charlotte. A lot of companies are coming there for that, and reason being, machine and equipment. So all the hosting equipment that you need, when you purchase them, they're exempt from sales tax. And as you know, in a data center, except for the structure of the building, your cost is all the equipment. So 80 to 90% of your operating cost is the cost of your machinery and equipment. So that will save you significant dollars. South Carolina, so they have a similar menu of incentives. Depending on the amount of jobs you create, you'll get a credit from $1,500 to $8,000 per employee. And that can ratchet up very fast, especially if you're, creating 100 jobs, 200 jobs, 1,000 jobs. And most times, though, that is reduced. It's not a cash reimbursement. You'll be able to get a credit on your tax liability. The other incentive I'd like to point out, okay, so South Carolina gives you an abatement on your property tax rate. So if you own your property, you own your land, you own your building, you're liable for some taxes, and they would, depending on how much you're investing, they'll say, okay, you don't have to pay any taxes. Again, significant dollars once you add them all up. They're also becoming competitive in the data center world, so they also identified that as an opportunity. And there's a lot of competition going on between states. All the states want your business. They want you to come to their state. And depending on how much you have on the table, you have the bargaining power. Very, very small example here. So you saw on the previous slide, North Carolina said there was no sales tax on equipment. Okay, so here they're saying, and electricity. So, it varies quite a bit, and they would do whatever they need to do to get you there. But the driving factor is how many jobs you are going to be creating. Okay. Very general legal environment issues to consider, to be aware of. Excuse me. From an accounting standpoint, we see this all the time, and the issues that's accounted by companies are basically caused by not consulting with your legal counsel up front when you're setting up your contracts, when you're setting up your sales invoices, fine prints are not read. You use generic information because it's cheap. You pull it offline and create an invoice. Okay, that all creates a problem down the line, especially when there's disputes. And as I mentioned, it's an extremely litigious society. Battle of the forms. So we call it the battle of the forms, and seller beware. So even though you're the seller, you need to be aware of this. It's also a change in mindset. Here you may not be expected to return something, because once you bought it, you're assumed to have done your due diligence, and you're assumed to looked at everything before you bought it. So you bought it, it's yours, it's gone. Well, not in the U.S. Even though that's expected, because of the environment that you're in, things come back to you. And that plays into warranties, that plays into guarantees, but you would be responsible. And even at the end of the day, you are found not to be responsible. Guess what? If you didn't do your homework, if you didn't prepare your documents correctly, you've incurred cost, and you've incurred business interruptions to prove otherwise. So it's a change in mindset. You have to be very, very careful with your documents. Marketing materials, operating manuals. Very often we find that the foreign companies push down your parent company rules, regulations, governance, marketing materials, okay, on a worldwide basis, and say this is what we do. Well, where that haunts you is in times of disputes and when you have to go to court to prove certain things. And they'll say, well, this is how you're doing it. Well, this is how we're doing it in India, because that's our manuals, okay? That's not really how it's done in the US. So there may be a difference between your salespeople in the US and what's being pushed down on from the parent company. And that comes out in court, unfortunately, where they see what you're practicing is not consistent with your corporate governance, your corporate structure. So there needs to be a sync, and all that you'll be protected if you get good legal counsel up front. Intercompany issues, and that ties into number 4, the tax considerations and transfer pricing, as we discussed. All this needs to be documented very carefully. What and how much, when and where. Because again, it'll come back to haunt you if there's an argument of manipulation of earnings, if things change from year to year. Pricing policies should be structured and documented. On an accounting side, revenue recognition is a hot topic in the US, and it comes down to pricing from parent companies. Arbitration. This is an important point. Many times that's overlooked, especially if you're downloading an agreement online to get it done cheap. It's overlooked, and then it's assumed that any dispute that you have is going to be resolved in the US or in the state that you incorporated, okay? But you have an option. You get good legal advice, and they may advise you to say, okay, in case of arbitration, why don't you consider international arbitration in a foreign country that's more favorable to you? So at least they bring that to the table, and you're not tied down to North Carolina law or New Jersey law or New York law. So at least that's on the table, and it could be at a much lower cost as well. So again, this is said on a high level, just for you to start thinking about and make sure you get the right advice up front. Okay, risk management, of course, on every level, it should be on everyone's agenda. Product liability. is a hot issue. As I say, things come back to you. Even though somebody has acquired your product, whether it's B2B or B2C, individuals, they will always come back and challenge you. So you need to make sure that you have adequately assessed your product liability and have adequate insurance for it. Expansion, this relates more to the various states and the various rules and regulations. One cannot assume it's consistent across the board. Even if you're acquiring a company from state to state, you have to be very careful. Most times the legal advisors will be able to represent you when it comes to negotiating incentives. Okay, high-level financial markets and funding. There's a lot of capital sitting in the US. There's a lot of PE funding that's sitting and just waiting and looking for the right opportunity. So there's various ways to get funding. It is difficult for a foreign company to get access. And that's why I mentioned they're always putting the seed money up front from the parent company. And then later on, after you get a year or so, year or two under your belt in the US, banks will be more willing to lend money and take out the parent company as the primary debt holder. But as you know, the US interest rates are quite low and attractive. Many companies get involved with leasing companies, so they don't have to buy equipment outright. That helps with the cash flow. Factoring is also an option. They're also regulating this factoring industry quite a bit now, which basically gives you cash up front for your sale of your receivables. And then I mentioned earlier where the state and city gets involved with funding. This is what they do. They raise industrial revenue bonds. And this doesn't happen every day. It all depends on the size of the deal. But the favorable thing is the interest rates are very low for that. Okay. I am very happy to say I'm not an immigration attorney. So I put these slides up there just for informational purposes. I mean, if you're coming to the U.S., opening up a business, you need to consider this. And we have a very strong relationship with the immigration law firm in the U.S. that's very affluent, very well known at the White House as well. So I can definitely refer you to them. But very high level, H-1B, H-4B, H-4. These are for sending your employees overseas. 2 weeks ago, the Obama administration is proposing that the H-4, by the way, is a spouse's visa. And in the past, your spouse was not allowed to work. They're just there to accompany you. So they realized, finally, that many of the spouses are very highly educated and skilled, but they're sitting on the bench. They're not doing, they're not contributing. So why not give them that opportunity to help the family, to earn money, but also contribute to the economy, contribute to the jobs. So that's in the process right now, and I think that's a great act that's coming about. More applicable to you, though, is the L1 and L2 visas, which is the business visas, and that's what you'll get initially as you open up your business in the U.S. And H3 is just a training visa. Regarding businesses, though, investments in the U.S., the EB-5 program was enacted a few years ago, but wasn't really acted upon. And now it's becoming extremely common, and many foreign investors are looking into this program, which basically gives you a green card after a period of time, depending on your investments, and that's the capital requirements for this program. So $1 million is a general requirement, $500,000 depending on the area, and the bottom line requirement is you need to create more than 10 jobs, and it has to be tied directly to the investment. And this is regulated very heavily by the government, and it's done through regional, what they call regional EB5 centers, which is approved by the government, regulated by the government, and monitored very strictly. So your investments are not just, you're just not investing in an ordinary fund. You know, they realize that these are your livelihoods, and of course, but all investments anywhere in the world have risk. So the time requirements is the 2 to 5 years that you would get your green card. So with that, it's very high level, general. I can definitely get you the information from the immigration attorney, but I just wanted to make you aware of it if you were not already aware of it. Okay. Exit strategies. This is very general. Of course, you sell your business, you can bring in partners, or you can liquidate your business. There's two parties very integral to this process, and that would be your tax advisors and your legal advisors. Not too many restrictions on cash repatriation, but you have to file your final income tax return. And once that's done, you'll be able to take out your cash. Okay, so with that, Mr. Desai, would you take questions? Well, I'm open for questions. Sure. Sure. Sure.
I can make a few comments.
Sure.
10 minutes. Then we take questions together, so that we have a comprehensive. You did a, I think, brilliant job in giving a summary of doing business in the U.S. as well as taxation. So maybe, if I don't mind, I think I would just make a few comments. I'm a standing counsel, so I always like, as a lawyer, to stand and talk. Okay. Thiru, thank you once again. As you mentioned, taxation. In terms of taxation, two things we need to note. One, at an individual level and at the corporate level. Incidentally, we have an office in Palo Alto, heart of Silicon Valley, and also I have a house in Palo Alto. And I just bought a house in Manhattan. So I'm unfortunately a regular taxpayer. And I've been going to the US since 1981, almost every month I'll end up. But one lesson I learned, for myself, was that I don't want to take green card. I do not want to become a citizen, and I do not want to spend substantial time so that I become taxable on a global basis, So, of course, it is all situational. There is nothing. You really made a good point on immigration. In the US, you really have to understand both the sides. One, your tax status, and also on the immigration status. And you already alluded to H-1B and EB-5. EB-5 has become very popular at this point in time, but people need to understand that if you take EB-5, you get green card if you put $500,000 in a specified geography for, as was mentioned in H-1B and H-1 as well. And third one is, my experience, I would generally recommend you to look at two types of visas. One, L1, because then you are entitled to break what is called a tie-breaking rule under the India-US tax treaty. I would not go into too many details, but ideal status for you would be L1 visa. Number two, maybe O visa, if you have special skills or stuff like that. Those are two visas possibly I would recommend if you are a high net worth individual and you do not want to get into, too many tax problems. Because as an individual, you have paid tax at the rate of about 15 to 35%. Once again, there are three levels of taxes. At a federal level, then you have a state level tax, and in some cities you have city level. Like in New York, you have a federal tax, state level tax, and the city level tax. So that's something that you need to bear in mind. Number two, that when you as an individual invest, you may be as a foreign resident. Now you invest in the stock of a US corporation, right? One other thing you got to bear in mind, do not forget there is something called estate tax. Under Code Section 865 of the US Internal Revenue Code, the source, when you sell, for example, shares of an Indian company, you are a US resident, now you sell shares of Indian company, normally we consider that the gain arising on the sale of Indian company share is the Indian source income. In the US, Code Section 865 says that the source of that capital gains, even though shares of Indian company, is US. So US would say, okay, you are a US resident, you are a US citizen, you have US source income. So we are going to tax you. And therefore you do not get tax credit as a US tax resident necessarily on the capital gains tax paid in India. Okay, so that is a major issue that is not resolved by the tax treaty. And therefore often you are compelled to invest through countries like Mauritius and stuff like that. When it comes to inbound investment from India into the US, because US consider that when you sell US company shares, gain even $1 billion, because it is an Indian source income. So the source of capital gains on sale of shares is where the holder of security resides. That's the principle in Code Section 865. So if you are an Indian resident, they would consider that it's an Indian source income. So they don't have a right to tax. And therefore even $1 billion capital gains tax would not be imposed, especially in case of a C Corp. Okay, that's a normal corporation, right? But typically the situation I see is that when you are US tax resident, you are always fond of LLC and LLP. And because you have only one level of tax. Okay. Now, typically, if you ask your friend, if you don't talk to Thiru, somebody like him, he will tell, no, I have LLC, there is one level of tax, you come and invest, right? Your problem would be that you would be deemed to have invested in the underlying asset. So, because LLC, which is allowed a pass-through status, you are considered to have made direct, it is a disregarded entity, sometimes they call it. So normally what happens when you LLC or other kind of entity which is eligible for election as they call it, I think in 75 days after incorporation you have to make an election, right? So you have to make the election. So if you elect to be treated as a pass-through entity, so it will be deemed as if you are directly invested in the asset. So now you have a problem that if you sell or transfer interest, they normally call interest, not the shares of LLC. So if you transfer interest in the LLC, typically your problem would be you will be deemed to have transferred underlying asset. So if it has a house, this, that, etc. If you have a C Corp, if you simply sell the shares, you capture entire value but pay no tax. Okay, so there is nothing like perfect world, but you need to consider some of these issues as well. And as I was mentioning that you are, as an individual, if you invest in the US and if you have assets, you also have to consider what is called estate tax. Again, federal tax and some states also have estate taxes as well. And the rate currently is 35%. And for US local people, it's I think $10 million exemption now. I think for foreign non-resident aliens, it's a very low exemption, 600,000, I don't know, whatever that amount is. So you also have to bear in mind that if you want to hold asset in the US, should you hold directly? Or you should hold through an intermediate company outside India, outside the US. That's one of the structures that you might want to consider. Number two, that a point was made with regard to, you know, the choice of entities. Within that, you also have something called limited partnerships at times. Mostly this is used by what you call VCs and private equity, most of them LPGP structure that's being used. Now there are, as he mentioned, you know, there is first form of organization is sole proprietors. The next evolution was limited partnership that first came in 1920 in the UK and then in the US as well. In limited partnership, there are, you know, all partners have limited liability, but one partner must have unlimited liability. Okay, so that is one thing you need to understand. Now, sometimes you try to become individually a GP, then you are unlimited liable. So your recourse may be that you might become you form a company and company becomes GP in the whole entity. So that is one way to protect your liability, because liability is a major issue in the US, you know. And then from LP came LLP, because in LP at least one general partner is required. Now professionals started saying that why should one particular partner take unlimited liability, right? So then they allowed a new kind of entity, what is called LLP. So every partner has limited liability, but mostly in the US it's used by professionals. In UK and Singapore, even non-professional businesses are now set up as LLP. And then came in the state of Wyoming in sometime in 1990-91, and a new animal you described, LLP, LLC. So it's a limited liability kind of company, LLC. It has limited life. So it has certain features of C Corp or a normal company and certain features of the partnership. But if you have more features of partnership, then you know IRS at that point of time said, okay, this you call it a company, but it looks like a partnership. So we are, for tax purposes, we are going to treat this as a partnership, but not. But it used to lead to a lot of kind of sometimes litigation, thick documentation, and all that. After some years, IRS said that okay, we don't want to get into the mess. You choose. You want to be a pass-through entity, or you want to be treated as like a C Corp, okay? And they allowed you to choose that, as I mentioned, in 75 days time. But once you do that, I think for 5 years you cannot change. And if you change, again, there are some tax consequences as well. So this is choice of entity is very critical as far as the US is concerned. And finally, you know, transfer pricing was referred to. You also have to bear in mind, in India, transfer pricing is not domestic. Primarily it is international. Of course, in some situation now it is coming up domestic as well for GAR and some reasons. But generally in the US, transfer pricing applies also domestically. That you need to just bear in mind. And finally, when it comes to arbitration, in the US, people do not like arbitration. They generally like courts. It's more efficient. But in India, we love arbitration. So that is another important thing that you have to bear in mind. One more small point I will make, when often you get into agreement, in India you say the governing law shall be that of India. In the US you have to be specific. Which state you should be applying the governing law, whatever it is. You know, these are a few points I thought will be helpful to you, and we'll be happy to take questions. And but maybe we should finish with Ruksha first, or we can take now questions, right?
It's fine.
Because
I think maybe better for you to finish.
well, yeah, we can take all questions together, you think?
Yes, I think
Is
so.
it okay?
Yes,
Thank you.
thank you.
So please, go.
Thanks, Thiru, for the lovely presentation, and thanks, Nishit for those very enlightening comments. Well, even I had some few points from the legal side and a few takeaways from Thiru's presentation, which essentially talked about a very regulated environment to deal with in the US, which is one of the most important factors for Indian companies considering outbound investments. Since I mean, of course, it's a known fact that given the solid regulated environment in the U.S., which is not overshadowed by corruption as recently in India, you know, so that has given immense confidence to Indian investors and global investors to look at U.S. as an opportune market. Also, the important point that Thiru mentioned, and a very interesting point, was the seller beware concept, which would of course in fact instill a lot more confidence in Indian investors or even global investors to seek and to make investments in the US, because it's not only the buyer that has to that has to take care and do the diligence on the investments made in the US, but it also imposes a degree of accountability on the seller, so because the law requires the seller to also be prudent in selling the business. So not only the buyer, but it also imposes a very high obligation on the seller, which would of course increase the confidence level manifold for any investor seeking to make an investment in the US. Besides, of course, we have contractual protections like representation and warranties and indemnities. But the fact is that if the law recognizes that the sellers will also be held accountable, that gives an increased standard of confidence to invest in the US. Also, another point, Thiru, you made was low debt financing in the US will not be available for foreigners. But given our regime, the ODI regime for companies to invest outside India, you could utilize proceeds from ECBs to make overseas investments, which essentially would drive you to the same standpoint because ECBs would be at a fairly low rate. So you would be able to use that low cost capital to make investment despite you not having access to US capital at a lower rate. And another point that would increase the confidence of foreign investors, including Indian investors, to invest in the US would be that there are no exchange control or repatriation restrictions, which would again give a lot of confidence for investors to invest in the US market. So just coming down to the presentation, so this is a broad overview on how you should make outbound investments from India and what is the Indian regulatory framework on outbound investments. So just segregated the presentation in these various topics, which is the current status of the Indian economy, reasons for outbound investments, the outbound investments which have taken place from India, landmark acquisitions, foreign exchange regulations, competition law, and certain key issues or considerations to be kept in mind whilst doing an outbound acquisition. So the current status of the Indian economy is that India ranks second in terms of economic growth amongst the BRIC nations. It appears to be stabilizing and turning around the corner. We've seen a very rapid spurt in the stock markets also just in the last couple of days, which is basically signaling a new government to run India in the coming few days. So IMF estimates a GDP growth rate of 5.4, which is estimated for this present financial year, and 6.4 for the next financial year. There had been a recent slowdown because of land acquisition, legal and political challenges, infrastructure, industrial projects being delayed. There was a slowdown in foreign investment, mainly due to policy paralysis, uncertainty in regulations, and of course the retroactive tax legislation that had been brought into India by the ex-finance minister, which has had a ripple effect until now on foreign investments coming into India. So because of that, we are seeing a lot of outbound investments happening now. Total outbound investments from India in 2013 was at 29.58 billion. As compared to 25.6 billion in 2012. The top 5 sectors for outbound investments from India were oil and gas, automotive, pharmaceuticals, healthcare and biotech, real estate, and telecom. Now, what are the main reasons for why Indian companies are looking to make acquisitions abroad? Number one is the willingness to enter markets where there are higher profit margin growth opportunities, establish research and development facilities, product and market diversification, access to natural resources, then global financing options would be readily available, educated and skilled workforce, a better infrastructure, and establishing their presence closer to their customers, especially for on-site support in the IT sector. Also, mature regulatory environment, which I just mentioned, and also Thiru endorsed that point in his presentation, that the market is fairly well regulated and in fact very well regulated in the US. Another reason is for Indian companies to look at global acquisitions is to acquire technology and brand name specifically. So they may not go for an entire buyout. I mean, they would go for acquiring a particular technology or IP or rights in IP. Healthy balance sheets of Indian companies have prompted now Indian companies to look outbound. Also, the prevailing policy paralysis, which I just mentioned earlier. Unstable political situation, which of course should turn around once the new government comes in, hopefully. And the aggressive stand taken by the tax authorities, which makes the tax environment very uncertain in India, which is why Indian corporations are looking at outbound investments to have some certainty on their investments in global markets. So this chart just sets out basically a statistics on outbound investments from India. So it also includes, intermediate holdco structures which have been used to invest in ultimate parent jurisdictions. So Netherlands, Singapore, British Virgin Islands, Mauritius, US directly were the most favored outbound destinations for investments from India. So the landmark acquisitions that have been made by Indian companies in the previous years is the acquisition of Coors by Tata Steel, then Zen Africa by Bharti Airtel, Imperial Energy by ONGC, Jaguar Land Rover by Tata Motors, and a few more that I've mentioned. So I won't spend much time on that, I'll just skip. The main important regulation to really consider whilst investing in overseas is the foreign exchange regulations, and in particular the overseas direct investment policy of India, the ODI regulations. Overseas investments can be made by individuals, companies incorporated under the Companies Act, bodies created under the Act of Parliament, partnership firms, mutual funds, registered trusts and societies, and proprietary concerns or unregistered partnership firms. It can be made, the overseas investment can be made in form of shares or any other foreign security that the Indian company can subscribe to. Of course, it has to be compliant with the local law requirements in that particular country where you are making the investment into. Other key terms of the ODI regulations would be that investments can be made from the following sources, from drawal of foreign exchange from the AD bank, capitalization of exports, swap of shares could be another form of investments that can be made out of globally. Approval of the Foreign Investment Promotion Board would only be required in case of a swap of shares which results in an investment into India. That's only on the inward leg of investments coming into India resulting from the swap of shares, and not for the outbound leg. Proceeds of ECB and FCCBs can be used for making investments outside India. Funds held in EEFC accounts and proceeds from depository receipts can also be used for making investments outside India. The total financial commitment of an Indian party cannot exceed 100% of the net worth of the Indian acquirer. This limit has been brought down recently from the earlier 400%. This ceiling of 100% is not applicable when the investment is made out of the EEFC accounts or from the funds raised by issue of depository receipts. The 100% threshold amount would include investments made in shares by way of loans or giving of guarantees, where 100% would be considered if the guarantee is a bank guarantee, or if it's a guarantee issued by the Indian parent to the foreign subsidiary, and 50% for a performance guarantee. Acquisitions can be made directly or through a special purpose vehicle depending on tax considerations. So in most of the investments we have seen is that intermediate holdcos are used, like how Nishit Bhai mentioned, through Mauritius, depending on the ultimate jurisdiction where you are investing into. Valuation of shares is required for an outbound investment, and if it is above 5 million, then it has to be done by a category 1 merchant banker appointed by the SEBI or by an investment banker outside in the host country, and in all other cases it can be done by a chartered accountant or a CPA. There are additional conditions which have been prescribed in the ODI policy depending on which sectors you are making the investment into. And the Indian acquirer is required to notify the Reserve Bank of India within 30 days in form ODI after making the investment. So it is just a post facto notification requirement which has to be made to the RBI through the AD Bank by the Indian acquirer. Mutual fund registered with SEBI can also invest in shares, bonds, fixed income securities listed on a recognized stock exchange or in exchange traded funds. Investments which are not permitted in the ODI regulations will require, or if you don't meet certain conditions or criteria which have been specified in the ODI regulations, will require the prior permission from the Reserve Bank of India. Alteration of the shareholding pattern, setting up of a step-down subsidiary is permitted from an Indian standpoint. Of course, you'll have to look at the local regulations also in the country involved, but with certain reporting requirements which have to be made post facto to the authorized dealer banks. One of the conditions which is prescribed in the ODI regulations is that Indian entities are mandatorily required to repatriate dues, that is dividends, interest, royalties receivable from the foreign entity, and report that, and the annual performance report is required to be filed with the RBI in this regard. Now, we've also seen, besides the foreign exchange regulation, before I go to the Competition Act, the Companies Act also requires, permits outbound acquisition in terms of, it says that if you are exceeding beyond 60% of the paid up capital or free reserves or 100% of the free reserves, then you require a special resolution in a shareholders meeting to be passed for making that acquisitions. Competition law is an important legislation that needs to be considered whilst making an outbound investment, in terms of that it's not only a legislation where you need to see in terms of making a domestic acquisition, but if your acquisition results in anti-competitiveness in India, or it affects adversely the competition in India, then you will be required to comply with the competition law. So two parts is that one is that you need to see if the transaction will cause an appreciable adverse effect on competition in India, and the second part is that you will need to see if the asset and turnover thresholds have been exceeded in any manner. So if the asset and turnover thresholds have been exceeded in terms of an overseas acquisition where you consider the group as a whole, one of the criteria is that one of the thresholds for asset and turnover is the group as a whole post-acquisition. So if that threshold is exceeded, or any of the thresholds under 5 and 6 of the Competition Act is exceeded, then you will be required to make a notification to the Competition Commission of India seeking clearance before you move ahead with the acquisition. There are certain exemptions that you can avail of under the Competition Act depending on the nature and circumstance of the acquisition. And if you fail to notify the combination to the CCI, if you were required to notify and you don't make a notification, then it can result into a penalty of up to 1% of the assets or turnover, whichever is higher. So this is an important legislation which needs to be considered even whilst doing an outbound acquisition. So based out of our experience, I just thought of listing down some key issues or considerations that need to be kept in mind for making an outbound investment. Number one is that the acquirer should have some sort of a strong brand name or an international repute to even go and pitch for the asset overseas. We remember that when Tata was thinking of acquiring Jaguar Land Rover, it was opposed by Jaguar Land Rover in terms of that Tatas did not have that significant a name in the car market, globally, as compared to Jaguar Land Rover. Local laws, regulations should be studied in depth, including competition, antitrust laws, and including studying in depth the employment law criteria or the employment opportunities that need to be availed of or need to be offered whilst making the acquisition. Because Vedanta's acquisition was of Konkola Copper Mines was criticized on them not creating local jobs proportionate to their investments. Present and indicative future political climate also in that jurisdiction needs to be factored into whilst making that investment, not to have a fallout like how GMR's contract was cancelled on developing the Malé airport. Investments limits to be judged prudently, not to fall into a trap like what has happened with Tata Steel's acquisition of Coors, which has faced a lot of issues, not only due to the global turndown, but also because of not enough business being generated out there. So now it's reached a stage where they want to sell off the assets of Coors to salvage the investments. And also you need to assess the business potential and the economic situation before making any outbound investment. As another example is that Hindalco Industries had to write off 1.5 billion from the acquisition, the cost of acquisition made in Novelis due to sluggish demand. So with that, I end my slide presentation. So we'll be happy to take any questions which the audience may have. And thank you all for coming out here. And I hope you enjoyed the presentation.
Well, I think it's been reset. We can have some questions. So at least we can start from now, so not delayed for lunch. Please tell your name, organization, and your question in brief.
My name is Soren. I'm with the Hinduja Group.
All right.
I have a question on the liberalized remittance scheme. Presumably with the new government and with the rupee appreciating, is there likely to be some move to raise the limits again?
Matter of perception, but yes,
Yeah.
it was not right in my view to have been done. It was reaction, a panic reaction, and because more confidence
Is that
crisis.
something the-
And I think Rukshad may also have his own point of view, so maybe we should.
So it was as Nishit bhai mentioned, it was a knee-jerk reaction. So with a 200,000 limit earlier and now being brought down to 75,000 USD. So it's, of course, I would presume that once things stabilize and once the economy is back on track, even with say 5.5 to 6.5% growth, my guess is that it would be raised. I don't think it would go up immediately to 200,000, but I think gradually it would maybe go to 125 and then be bumped up to 200,000.
Amit, do you have any
Is this,
thoughts on this?
Yeah, as far as I know, the RBI is already considering that and it is bound to go up, most probably to the previous levels.
Is this something the Institute of Chartered Accountants can play any role in recommending or furthering? Do they have any influence in these matters?
I think Hindujas can do better.
Well, we charge a hefty fee for that.
And start with $1 million. I think we were all expecting the limit to go to $1 million. It was almost 10 years ago. I think we backtracked. So
I better give the mic
you
to
have
someone
more
else.
power than
No,
us.
actually,
Okay.
even with 200,000, it really made no sense, for HNIs also, they were juggling around
Right.
making one investment in the end of March and then doing another one the first week of April. So effectively it was being done that way, so even 200,000 was not enough. So as Nishit bhai mentioned, so for HNIs to acquire houses, it's required at least for $1 million plus.
Yeah, and they removed real estate from
Yeah,
the application of money. I think that was also not right. I think first thing anybody would taste overseas is real estate because you get touch and feel. It feels a little more safe than markets or otherwise. So hope they restore that. And
They proposed a law in the US, I think, that you can invest 500,000.
That is
but
EB-5
it
visa.
was shot down. It was
Yeah,
shot down.
but they take $500,000, but take your world because you get
Correct.
green card and you pay tax on worldwide income, I think. So
Benefits
therefore I
of being
decided for
American
40 years, I said I don't want these three things to be my way. Please, your name,
Yeah.
organization and
John Alexander from Fernlees.
From?
Thank you. Fernlees.
fun.
Thank you for your, sorry. Thank you for both your excellent presentations. This is actually geared towards Thiru more than you, but in any case, both of you. Very quickly, I'm asking this out of ignorance. I'm from the oil and gas industry, and I was just trying to figure out whether, in terms of investments into the US, do you think there could be an impact if there's no FTA between India and the US? You know, in terms of oil and gas, there is an impact because even if you invest, unless it's guided by an FTA agreement, or you have to have a specialized non-FTA clearance before you can export a product that you have there. I don't know if you're aware of that, but I just thought I'd bring that to your consideration.
Yeah, that's, you know, firstly, shale is still undermined there in the US. So there's a lot of, so there's still a lot of potential there. But as far as the agreements in place, I can't speak to that. But I definitely know, I know with other countries as well right now, like South Africa, for example, the opportunities there are ample, and the US is trying to invest in there and trying to take advantage of that, but they still have that opportunity in the US to be explored as well.
Maybe I think as far as oil and gas, it's exploration of oil and gas is one game, but there are a lot of opportunities in acquiring some manufacturing and some other parts, you know, when you have Christmas tree and different segments you get into, or technology for spillage and stuff like that. So long as it is not a dual use technology, that should be less of a problem. But if you're going to actual exploration or stuff like that, and very close to that, there are special. Yeah, please, your name. I think one gentleman after. Yeah.
My name is Shankar Chatterjee. I have an LLC company in Pennsylvania right now. It's formed recently. But there's someone who told me for an international business, apparently an ink company is more conducive to such a requirement. Now, in your presentation, which was otherwise excellent, I did not find the option of INC. Could you just enlighten me a little more about that?
I think C Corp, what he mentioned, is ink, basically. So INC, what you call, is regarded as, he will be able to tell you more. But what I also mentioned in my presentation was that if you sell shares of an ink, or what is called C Corp, okay, subchapter C, then you, if you are Indian resident, not a US citizen, green card holder, or substantial person, then you don't pay capital gains tax in the US. So you can sell the whole business, zero tax. But if you have an LLC and you sell, it would be deemed that you have sold underlying assets. So that is not tax exempt. Whereas shares are considered to be intangible. You know, a lot of people think whether it's tangible or intangible. Technically, it is intangible. Intangible resides where the person resides. In India, for example. Therefore, US will say, we don't have right to tax, we don't tax you. So better to have C Corp than LLC. But I think Thiru would be much more qualified to speak on this.
I think you hit the nail on the head. But so I believe it's very difficult to zone in on that, because whether you do an LLC or an Inc. or a C corporation, as I mentioned, it all depends on your business strategy and your goals, and you know what's your exit strategies. And it's a big picture look before that should be determined. You know, to say whether an Inc. or C Corp is the best way out for you.
One small issue, I think, from Indian perspective, I may mention. See, we are all familiar with company, we are familiar with partnership, but Indian tax department is not familiar with LLCs and LLP. So they would consider this as a partnership. Now, your LLC, if it is even fractionally controlled or managed from India, the entire LLC may be brought to subject to tax in India and its income. it may be treated as a tax resident of India. Under the Indian law, the rule is that if you have a partnership abroad, okay, and if a fraction of a control, 0.01% control resides in India, then entire partnership is deemed tax resident of India and taxed on the worldwide income. So you pay not only tax in the US, you also pay tax in India. And then you have to interpret tax treaty, which does not very clearly come out because the rules are a little more tricky as far as the partnerships are concerned. And it may not be even eligible for the treaty benefits because one of the clauses in the tax treaty says that if you are considered a partnership, then the treaty benefits will be available only to the extent to which it has US tax resident as partners. So again, that is another issue. So from US local people, LLC is a great animal. For, I assume that you are not a US resident, right? So then it may be a different situation. So I'm not very comfortable. Yeah, you can still use it if you at all want to use it by interjecting an intermediate company outside India, outside the US, and that company can become member of LLC if at all for other reasons than I mentioned, you want to still go ahead with an LLC. That would be my take. Anyone wants to add something, please feel free.
Yeah, as you said,
Please.
it's very difficult to resolve it in the treaty.
Right.
So it becomes difficult when you have LLC, so it's very difficult to get results. And then you get into the complications of individual partner becoming tax residents of various country and then those treaties get applied. So it's actually, what he's saying is right, it's a very complex structure to get into.
I'd like to ask a question.
Just one second, please. Yeah, go ahead.
What are the chances of an H-1B visa holder who has been there, earlier on an F1 and then he becomes an H-1B, for him to become involved with an LLC? Where is he
H1
taxed?
He will, in the US?
Yes, he is in the US, let us say. They are in the US.
LLC
Because
will be
I have seen a lot of our IT guys
I know,
who have gone there to study on an F1, now graduate to an H-1B visa,
Correct.
and have started owning corporations. That means LLC programs.
Now, the thing is, if they have stayed there for a reasonable period of time, therefore they are non-residents from Indian perspective. So India may not be impacted so much. But from local perspective, if they've set up an LLC or LLP, okay, it would be regarded as a pass-through. So they will be taxed in the US only on their share of income from the, because LLC as such is not taxable.
But at this moment, they are NRIs.
It doesn't matter.
Doesn't
as far as
matter.
India is concerned, if you are a non-resident from Indian tax perspective, then you are not taxed on your foreign income. You are only taxed on your Indian income.
So when
This
he
is a foreign income in
All
the
right.
US, but H1B is one, but H1B is not as good as L1 or O.
So when this H1 gets over, after this 3 + 3, 6
7,
years, and they come back to India, but they still have their involvement with the LLC,
Correct.
what happens then?
Then you have this problem which I mentioned.
Ah,
That, yeah. That's simple. Because then you have to go through. I think you have a question. I'm sorry.
There are one or two small observations. Sir, you have not mentioned whether this service tax is applicable in USA.
What is it?
Service tax
Yes. So
and
we call it-
professional tax.
Yeah, service tax akin in the US is sales tax.
Okay. Professional tax.
Some states have.
Yeah,
Yeah,
most
different
states
states.
have
Yeah.
sales tax.
Yeah.
It varies
Yeah.
by state. Some have a 0%, 3%, 8% sales
And
tax.
so, how much time would it take to incorporate LLP or INC in USA? I mean, because in India it takes a little bit more time. So,
How much time it takes to...
incorporate, sir.
I would say it would depend on how long your agreements are,
Yeah.
how long your agreements take to be drawn up, but I think the formalities could be about 10 days or less.
Some states have gone for online incorporation, so it
Right.
takes 1 hour.
Yeah.
It costs you about $400-500 to $3,500, depend. But important thing is depending on your business, right from day one,
Yeah.
you need to structure a memorandum and articles. In the US, it is all the more, as you mentioned, accountants don't do it because it's primarily a legal work.
Correct.
And
Good
license
attorney,
to
yeah.
practice law is only with lawyers. There is very strict reference here because privileged communication, confidentiality, all that is not available.
Right.
So US society has slightly different approach than what we have here. So you can do it online, like popular state is Delaware. Now not because of tax reasons, but because of its corporate law. Most of the rules in Delaware are in favor of management. So therefore you do it. But in a couple of hours you can set up.
In one of the slides you mentioned that there is no personal liability, you know. I mean, can you slightly explain about it?
So-
Incorporate a company.
Yes. So when you incorporate a company, and first going back to your previous question, as Mr. Desai mentioned, so the actual formation of the LLC takes, minutes online, but it's more involved than that. It's more of your agreements too. And one of the things that's important is the personal liability. Personal meaning bifurcation of your personal assets and your company assets.
Right.
Okay, so you don't want your house, your automobile, all your personal assets being subject to any liability from your company.
But in India, sir, if you enter into any agreement with the financial institutions, this clause is normally available, sir. That personal liability will be there, you know.
Unless you give personal guarantee, there is no personal liability when you do a
Yeah.
business through a company. That's simple as that.
And sir, last
Any
one-
other question?
Yeah, okay. And so last,
Thank you.
my request to this is why that we can get a presentation of both the settlement by through a soft copy or something will be
Yes.
very.
Sure.
Can we share?
No,
And you
that
know me
would
well,
be-
but my name is Pramod Shah. I am Presidency Company Secretary and I am former Chairman of the Institute of Company Secretary of India, Western Region. Thank
He's
you.
a veteran here.
Thank you for your
And he
questions.
had a brilliant presentation today, so
Thank you.
we're happy to share.
Thank you.
Any other question? I think our presentation was very clear, looks like. Any more questions? Or we can adjourn. As I mentioned, that don't forget to take care of your estate tax in the US. Because mentally we are not aligned to estate tax, there is no estate duty in India. It used to be, we used to have a rate about 80 to 85%, only 20 lakhs rupees exemption. In the US, again, it's very low exemption for non-resident aliens. Otherwise, exemption currently is $10 million, but for US resident, US green card holders, substantial presence. But non-resident aliens, I think, have 600,000 or something like that. So even if you buy stock on a US stock market, there are something that you need to clarify. Second, once you get green card or citizenship or otherwise, if you hold it for a period of 8 years out of 15 years, if you give up citizenship or green card, then it is deemed that you are disposed of your global assets and you have to pay capital gains tax in the US. So these are, once your neck is in, you can't take it out. Same thing, if you ever want to set up a global headquartered company, don't go to the US, okay? Once you get your inversion, that is called inversion, when you want to move US company to non-US jurisdiction, it's a very big pain in the neck. It's a very expensive process. It is deemed that the shareholders of the US company have disposed of the shares when you migrate company. Now you must be aware of the last case of Pfizer wants to move the headquarters to the UK, of course, because of certain exceptions. They are still working on that, but it's a nightmare. It's a nightmare. So never incorporate headquarter company, never, sorry, go to the US to take citizenship, etc., unless you want to be your children to become presidents, So
No, they must be born there for that.
So generally I am not very fond of. I like to go there, make a little bit of few pence here and then come back to India. But wait, pay tax there, whatever you earn there.
Well, just one final overarching comment from me, and there's no one size fits all. Everybody has a unique situation. And the tendency in the US is, get things done fast, get things done cheap. But my advice here is make sure you have consulted with your experts. I mean, an easy thing like incorporating, it takes an hour online, $400 or $500, but you may be missing the big picture. On your tax returns, people don't think about estate. People don't think about about creating trust. People don't think about what happens if you unfortunately pass. So all those things need to be considered. It's just not a matter of filing a quick income tax return online for $20. You need to really get the right advice, and so you can protect yourself.
Thank you. Since there are no questions, I believe, final opportunity. If you want to ask free advice, welcome. So, but if I may put it, Amit, maybe you might want to say a few concluding words, and Prashant, you have, both of you.
I just want to say that, yes, US is a complex country in terms of regulations, but it is the world's biggest market, and it's a must-penetrate zone for a lot of Indian companies. And I think through this presentation, you would have got an idea about at least where to go and what to keep in mind, and do your due diligence before you do business with US or invest in US. So I hope that you found the presentation useful, and in the lunch we would be there to help you. Thiru would be there to answer any of your other questions if they come up to your mind. Thank you.
Also in terms of diversification of risks, it would be very useful for Indian companies to look at global markets. And since US is looking at a higher growth trajectory now going down the line, it would be the most opportune market because it's the one of the largest economies in the world. So it would be the most opportune market for Indian companies to look at.
Well, they said it quite well. They're trying to sell the US for me, so that's great. Now, we were having a discussion offline earlier on, there's a lot of perceptions, even doing business in India, doing business in the US, about all the regulation and compliance. But if there's opportunity, you got to take advantage of it. And in both countries, there's ample opportunities, synergies that hopefully going forward after the new regime, things will get much better, and investment opportunities will flow back and forth.
Yeah, thank you so much. I think one opportunity don't miss. If you go to North Carolina, go and visit the Research Triangle. It's one of the finest places you'll find. Every single top company in the world has a research base in North Carolina. And the way in which they have developed the whole Research Triangle, I've gone through and drove miles in that region. It's amazing that so much is there in North Carolina. I think we often don't just know about it. So please, I suggest that whenever you go there, just find a little time, you'll really enjoy.
And they have their offices in Raleigh. They have their office there.
Therefore, I mentioned I thought it would be. You also have a good guest there, host there, sorry. And so he'll bear your airfare and he'll give you everything. It's a friend, ultimately friend. So thank you so much for your patient hearing all the way you waited, and I think I know you're hungry for knowledge, but also you're hungry for food. And enjoy your time. Thanks a lot. Is there lunch, by the way?
Yeah.
Oh, sure. I'm sorry, without permission I talk.
No, it's perfectly fine. There's...
Oh, yeah,
As
please.
we have come towards the end of the program, I would request Rakhi to kindly propose the word of thanks.
Hi, a very good afternoon, ladies and gentlemen. It's a heartwarming and rewarding to see that we have continued our founder's dream and organized this very important event today on business and investment opportunities in the US. As we come to the end of our program, on behalf of the Chamber, I would like to extend my heartfelt gratitude to all those who have responded to our invitation to attend today and contributed, you have contributed well to the conversation. I would like to take this opportunity to thank Mr. Nishit Desai from Nishit Desai Associates and today's session chairman for chairing this session. We look forward to a long association with you and your firm, sir. A very special thank you to Amit, Thiru, and Rukshad for being with us today, for sharing your expertise. We look forward to associating with your firms as well, and you. Thank you so much. It was a pleasure going through your presentations. May I now request Mr. Desai to present all the distinguished speakers a small token of appreciation, please.
Okay, sir. Lawyer has to read everything first. Thank you so much for brilliant exposition. Ruksha, it's always a pleasure to see you. You do a brilliant job. Thank you. You know, small.
And this is for you, Mr. Desai.
Okay, thank you so much.
Thank you also to the staff and management of Ambassador Hotel for ensuring a smooth event. I would also like to thank Mr. Vishwanathan, Sneha, Trishla, Naomi, Archana, Shweta, Trupti, and Sneha Kutarkar from ICC for all your efforts and coordination in making this a big success. Thank you. And before I conclude, I know I'm holding you all back from lunch, but I would just like to make a small announcement. We are also organizing a farewell reception for Consul General under the auspices of IAS, IACC, AmCham, US India Importers Council, US India Investors Forum, Travel USA Committee, which represent all the Indo-US bilateral organizations here in Mumbai. As you all know, we are a not-for-profit organization and we need to raise money for all our activities. So I would request if any one of you through your organization would like to, associate in this activity of ours, please feel free to contact Trishla or anybody from us from ICC to sponsor this event. And this event will give you a good amount of branding and exposure to the entire Indo-US community here in Bombay. Thank you so much. And I would request everyone to please gather there in coffee shop for lunch. The lunch is being organized there. Thank you so much. Thank you. And please join us for lunch. Thank you.